Good afternoon, boys and girls. It's Liberty Call for Thursday, April 14th, 2022. I hope everybody's having a fantastic day out there in the interwebs. You can see my little puppy back there. Well, he's not little. He's a 13-year-old giant dog. Uh, he's the director of security around here at DSA Financial Group. So be careful if you see Barney coming at you. Anyways, kind of a back and forth day in the markets. Started out down, went into the green, and then finished up in the red. So I think just people are, nervous about what they're, what to do with their investments right now. And, I think the volatility in the market is definitely showing that. So again, put on your seatbelt, buckle up, folks. It is going to be a rough ride out there. So, all right. Get my shirt fixed. It looked all disheveled. Boop. There we go. Ignore the stains on my workout clothes. Anyways, all right, well, let's go ahead and jump in and take a look at the markets. Dow Jones finished down 0.33% at 34,451. S&P was down 1.22% at 43.92. NASDAQ was down 2.14% at 13,551. Small caps are also down a little more than a percent. The VIX was up nearly 4% at 3.94%. And we're sitting at around 2266 at this moment. Moving down over to the other Americas, Canada was slightly up at 0.08, Brazil down 0.85, Mexico up 0.49. Going over to Western Europe, a lot of greens from Germany all the way down to, where is this? Is this Romania? Austria. None of them over 1%, but all of them solidly in the green. Then we have another stretch of reds here from Sweden, Denmark, and the two Russian indexes. The Russian indexes were beat up pretty good today, down 4.89 for the MOEX and 5.62 for the RTSI. Then we have another stretch of greens from Hungary was up over 2%. Japan was up over 1%. Both of the, Australia and New Zealand were both up about 0.5%. The Chinese markets, the Shanghai, the SESE component, the China A50, and the DJ Shanghai were all up over 1%. And the Hang Seng was up 0.67. Taiwan weighted down slightly at 0.32, and kind of mixed on the rest of these. So all in all, starting out over in Asia last night, things looked pretty good. Had a few missteps along the way in some of the Eastern European countries and Russia, and Western Europe was all greens. And then we finished out, it looks like, the large caps were, down, the blue chips were down about 1/3 of a point. Large caps were down about 1.25, and the tech sector just got pummeled. It was down over 2%. So not the best day. Again, we're headed towards some volatility, so don't get your panties all in a wad. It's just what the way it's going to be for a while. Unfortunately, if you want to blame someone, you can probably blame the assholes in Washington who have put us in this situation with high inflation and way too much debt as a country. So, but that's just my opinion. So you can take it for what it's worth. All righty, market recap article here. S&P 500 slips as yield spike puts tech in crosshairs after bank earnings. The S&P 500 slumped Thursday as a wave of mostly better than expected quarterly results from major Wall Street banks failed to lift investor sentiment as tech stocks resumed their trend lower. Major Wall Street banks, including Goldman Sachs, Morgan Stanley, Citigroup, reported first quarter results that beat analysts' expectations, but Wells Fargo fell more than 5% after reporting a decline in a quarterly report. The fall in bank stocks comes in the wake of rising treasury yields, which tend to boost margins on lendings for banks as investors bet the Federal Reserve will lean aggressive on monetary policy tightening to curb inflation pressures. The pace of the surge in yields has placed growth sectors of the market in the crosshairs, with big tech leading the decline. Apple fell 2%, while Alphabet, Amazon, Microsoft, and Meta platforms were down more than 1%. Twitter turned negative as many doubt that Tesla chief executive Elon Musk's $54.20 a share offer to take the social media company private will succeed. Let me stop there. 54.20. So 5,420. Elon is hilarious, putting a little cannabis in there in his price. But looking at the Tesla price, they were trading in the mid to high 40s when I looked earlier today. And so it's about a $6 or $7 premium on the price per share if Elon is actually going to do it. So I think he's personally got the folks at Twitter over a barrel at this point, because he already owns 9% of the company. And if he were to dump that stock, because he said in his message or note to I don't know if it was to the Twitter board or whoever it was in his offer that hey, if we can't make a deal to take this private, I might have to sell all my stock, which, boy, that's really going to hurt the bottom line, it's going to really hurt your share prices, which then affects a lot of other things when it gets into lending and all sorts of stuff that these companies do to leverage their shares. So it's going to be interesting. I'm sure all the pink and blue haired woke weirdos out there are freaking out. I don't normally go on Twitter very often, but I did click on there just to see what was trending, and that was number one. So it was kind of funny to see all these woke idiots getting all upset about it. People like Jeff Tiedrich and the like, who they don't seem to like people who aren't in their, I guess, groupthink having any control over social media. So anyways, jumping back in. Quote, in our view, the deal does not get done at this level, and Twitter's board will not review this offer or Mr. Musk leading a change in the company as in the best interest of the company or shareholders, end quote, Wedbush said in a note. In other news, United Health Group, a major Dow component, was up 0.5% after cutting intraday losses following better than expected quarterly results and an increase in full year guidance. Allergies here in Colorado. Energy up about 1%, attempted to cushion the broader decline underpinned by rising oil prices on fears about tightening global supplies as Russia and Ukraine look to engage in a massive land battle in eastern Ukraine. All right, more war. On the economic front, investors digested a weaker picture as data showed initial jobless claims rose more than expected, while the latest retail sales report flagged the impact of red-hot inflation on the consumer. Still, economists remain sanguine on the strength of the consumer, citing excess savings built up during the pandemic. Quote, we remain quite constructive on the outlook because of the combination of excess savings and robust wage growth, particularly in the bottom half of the income distribution, end quote, Jeffrey said in a note. In other news, Peloton Interactive fell more than 4% after the fitness equipment maker cut the prices of its Bike Plus, and tread machines, but raised the monthly fee for its on-demand fitness content as it looks to regain user growth. So, like I said, kind of a mixed day. Bank stocks were down due to rising yields should usually be good for bank stocks, but again, everything's just kind of disconnected and out of whack right now. So it is a little weird. But the Twitter news is funny. They're not even gonna. Is that really in their best interest for their shareholders to not at least look at the offer and see if shareholders might be interested in making a nice little. Let's calculator here. So Twitter, let's say 54.20 minus, let's just say $46 a share. So that's about $8.20 premium divided by 46. That's a 17% return. So I don't know if they can really avoid that or just push away that offer and not even act like it was there. So anyways, it's interesting. Next article, inflation and rate hikes ahead. Bankers cautious on the economy. Wall Street major banks and asset managers were cautious about the economy as they detailed how both consumers and institutional clients were struggling to deal with sky-high inflation and looming rate hikes. The big U.S. banks are reporting results at a time of surging inflation, which is leading to predictions that the U.S. Federal Reserve will hike interest rates aggressively this year. While that can be benefit big lenders by increasing what they earn from losses from loans, Rapid rate hikes could slow the economy and scupper a nascent recovery from the pandemic. And scupper in the sense, God, these people, check your, please proofread your work. Quote, higher rates are typically positive for banks, said Jason Ware, chief executive officer at Albion Financial Group, which holds JP Morgan shares. But if borrowers are unable to absorb higher borrowing costs, it is an offsetting benefit. There could be a headwind if they rise too much, end quote. Several banks started stockpiling cash to cushion potential losses, loan losses if inflation bites. While that showed some banks were getting more concerned about the macro environment, it was, quote, not necessarily a prognostication. We will hit bad economic times, end quote, Ware said. Mortgage rates, meanwhile, have been soaring, while the average interest rate on the most popular U.S. home loan rising more than 5% last week, the highest level since November of 2018. Quote, all of our clients are feeling the impact of the inflationary pressures across the board. Wells Fargo Chief Financial Officer Mike Santo Massimo told reporters on a call, while Santo Massimo said that inflation has not yet shown up as a risk for banks' credit portfolios. The bank said that higher interest rates would hurt mortgage volumes. Mortgage rates fell 33% from a year ago on loan originations and gains from home sales. Lower income consumers are being the most impacted by rising energy and food prices. Wells CEO Charles Scarf said later on a conference call. Scarf said that while the bank would likely see an increase in credit losses from historic lows, quote, we should see a net beneficiary as we will also benefit from rising rates, end quote. JP Morgan Chase & Co.'s chief executive Jamie Dimon on Wednesday warned of economic uncertainties, partly arising from soaring inflation. The bank also showed weaker mortgage lending with loans down 3%. Albion Ware said, however, if inflation does come down and growth does normalize, the benchmark 10-year U.S. Treasury yield, which influences mortgage rates, could settle, which would be good for mortgage rates and borrowers. Many Wall Street analysts and investors believe the U.S. Federal Reserve has acted too slowly to combat high inflation and are now forecasting even more aggressive rate hikes as the central bank catches up. Well, I don't think that they were too slow. I think that they caused this problem by the money printing and the actions to Treasury and our federal government. So, it's not like they, 2 years ago were like, well, if we print all this money, nothing bad could happen. I mean, come on. What is a 40% increase in the money supply? I didn't go to take an economics class ever. I'm just here running the Fed or running the Treasury. I mean, come on. It's a bunch of BS. These folks knew exactly what was going to happen, to save face and save the economy and, help out their big business cronies. That's why they did this. I mean, hardly any of this money went to the little people down at the bottom. I mean, those stimmy checks were a very small portion of the all the money that was created over the last 2 years. So, out of the 5 or 6 trillion that was printed, how much of that actually wound up in the pockets of people who really needed it? People were laid off. Because those are the folks with the who didn't have the laptop jobs. People who go to work and go to restaurants and those sorts of things. Those are the ones who were displaced when everything shut down for several weeks to several months, depending upon where you live. So, to point fingers at the Fed, and say, well, they could have done something sooner. That's just drives me up the damn wall. Diamond expects higher rates that the market is pricing in, currently 3% at the end of 2023. He said Wednesday. I think it's going to be a lot higher than that personally. Quote, those are storm clouds on the horizon that may disappear. They may not, said Diamond. Quote, that's a fact. And I'm quite conscious of that fact. And I do expect that alone with will create volatility and concerns, end quote. Diamond said that the Fed's quantitative tightening as it reverses its pandemic-induced bond buying bonanza will be, quote, more substantially important than other people think, end quote, because of the huge change in investment flows as people adjust their portfolios. Goldman Sachs CEO David Solomon, meanwhile, said the company's earnings call that he was watching inflation, stress on the supply chain, commodity prices, and how U.S. households were coping with rising costs. Quote, we've seen an increased risk of stagflation and mixed signals on consumer confidence, said Solomon. These cross currents will certainly create ongoing complexity in the economic outlook. That's a word salad. BlackRock Inc. described how clients were grappling with the changing economic landscape and adjusting their fixed income portfolios. Quote, our clients are trying to understand the implications of the rapidly changing investment environment, said Lawrence D. Fink, chairman and chief executive, who pointed to Russia's invasion of Ukraine as creating a supply shock in commodities that is further increasing inflation. Come on. Russia, Ukraine did not cause all of this massive inflation. It helped it, but it didn't cause it. So, anyways. All right. More articles about what the Fed's doing in the U.S. economy. Recession is now the, quote, most likely outcome for the U.S. economy, not a soft landing, Larry Summers says. And Larry Summers is a former Treasury Secretary, for anyone who may not know who this guy is. Former Treasury Secretary Larry Summers, whose out of consensus views about the risks of persistent inflation have come true, is reiterating his concerns about the potential U.S. downturn. He now says a recession is, quote, the most likely thing, end quote, partly because of the Federal Reserve, quote, is going to have to keep going in its effort to subdue inflation until we see disinflation, end quote. In an interview with Bloomberg Economics released on Thursday, Summers, a paid contributor to Bloomberg, said that, quote, the odds of a hard landing within the next 2 years are certainly better than half and quite possibly 2/3 or more, end quote. One of the mechanisms that will bring a recession is the central bank's response to elevated inflation, Summers said, adding that we're not going to see disinflation back towards the target range until we see unemployment rise meaningfully, end quote. The publication of Summers' comments comes just 2 days after the Consumer Price Index data showed that the annual headline U.S. inflation rate jumped more than 8.5% in March, the highest level since 1981. The rate has remained well above the Fed's 2% target for almost a year, putting central bankers under pressure to aggressively raise target lending rates. Expectations for higher rates are rippling out through the economy, with the average 30-year mortgage rate soaring to 5% for the first time in a decade. Meanwhile, financial market participants continue to debate whether inflation has hit its peak. I don't think so. Quote, if you look at history, there has never been a moment where inflation was above 4% and unemployment was below 5% when we did not have a recession within the next 2 years, end quote, Summers said, according to a Bloomberg transcript. Quote, I don't think the idea that is still embodied in Fed forecasts that we could have continuing super tight labor markets at 3.5% unemployment, and we could have inflation coming down rapidly. It is a terribly plausible one. Generally, economists appear to be coming around to the potential for a downturn. A Wall Street Journal survey of economists in April puts the odds of recession in the next 12 months at 28%, up from 13% a year ago. 28%. This is hilarious. I mean, again, the world is fluid. Things can happen. Things can change. And, the fools who are steering the Titanic from England to New York Harbor could miss every iceberg along the way. I know I've said this probably dozens of times in meetings of late, but, it's hysterical that, you're going to have to raise rates high enough to, see a reduction in inflation. And, looking back at the most recent event where we had this sort of situation was back in the early 80s, and interest rates were up in the teens. And, you had to eclipse the inflation to actually squash it. So, I would be raising rates 1% every meeting until you start to see it slow down or recede. But hey, these are the smart guys. I'm just some dipshit sitting here in the mountains who, I mean, this is not rocket science. It's supply and demand. So anyways. All right. One last article. It's a quick one. It has to do with expenses and retirement. It's titled 4 Big Expenses You Should Factor In for Your Retirement. Retirement planning is part savings, part guessing game. While many of your day-to-day expenses will remain the same, there are big ticket categories that can take a big bite out of your savings. The more you plan, the better prepared you'll be to weather the costs. Here are 4 expenses to keep in mind as you prepare for retirement. First is healthcare. The average 65-year-old couple will need about $300,000 in after-tax savings to handle healthcare costs in retirement, according to a 2021 report from Fidelity. Fidelity is a NerdWallet partner, quote, and that's just for regular healthcare, end quote, said Michelle Gessner, a certified financial planner in Houston. That quote, that's not even counting unexpected chronic illness care. End quote. Your specific costs will depend on where you live, how long you live, and your overall health. Taking care of your health and adequately managing conditions like type 2 diabetes can keep costs lower. The overall health or other health care surprise is that Medicare premiums are higher if your income is above a certain level. For example, if you're married filing jointly with a modified adjusted gross income over 182,000 in 2020, you'll pay at least 40% more for your Medicare Part B premiums, monthly premiums. In 2022, the standard premium costs are about $4,000 a year per couple. Quote, it really creeps up, end quote, said Lori Burkhart, a CFP in Boston, quote, and it's easy, believe it or not, to get to that level of income when you're at the age where you're taking required distributions from your IRA, end quote. Next is long-term care. Seniors who live to 80 have about a 1 in 4 chance of needing long-term care, and it's not cheap. An assisted living facility costs about $4,500 a month on average. And while a home health aide averages about $27 per hour, the costs add up. Quote, that's pretty reasonable if you only need a few hours of care per week, said Patty Black, a CFP in Birmingham, Alabama. Quote, the math becomes unworkable the more care you need, end quote. Certified financial planners can help project costs for a few years of long-term care to ensure their savings can handle it. Quote, I talk with clients about whether long-term care insurance should be part of their financial plan to transfer some or all of the risk, end quote, Black says. Next is dental care. The average senior on Medicare using dental services paid nearly $900 a year out of pocket, according to the Kaiser Family Foundation. A 1 in 5 Medicare beneficiaries spent more than $1,000. Original Medicare doesn't cover most traditional dental care, and 47% of Medicare beneficiaries go without any dental insurance. But gum disease, tooth loss, and oral cancer are great concerns for seniors, and finding comprehensive dental insurance can be difficult. Quote, dental procedures can be a really rude awakening, Burkhart said. I'm going through it right now with my husband, who is retired and getting a dental implant. He's been shocked at how much the out-of-pocket is, end quote. And lastly, it's prescription drugs. Since 2014, at least 1 million enrollees per year in Medicare Part D have had drug costs high enough to exceed the catastrophic coverage threshold, which is $7,050 in 2022. If you have a condition that requires specialty tier drugs such as cancer, multiple sclerosis, or Hep C, your out-of-pocket costs can be exceptionally high. Once you hit the catastrophic threshold, you'll pay either a small coinsurance or copay for drugs, but there's no cap on the out-of-pocket spending under Medicare Part D. It can add up if your drug is expensive. Quote, my dad has rheumatoid arthritis and his drug costs about $6,000 per month, says Tess Zigo, a CFP in Palm Harbor, Florida. Quote, what retiree has $6,000 a month just for drugs, end quote. I can relate. I take Remicade every 6 weeks, and it's about $5,000 to $10,000 per infusion. So I imagine there's a healthy markup in there that my doctor has and the drug companies do have. So it is not cheap for my care, and it's one of the downsides of having my genetics. So anyways, all right. Well, that's everything I had for today. Some kind of a bumpy day out there in the markets. I would expect we're probably going to have a lot of this bumpiness until we actually start to get into some sort of a descent in the markets. But until then, if we get another leg up, we'll profit from that. But until then, it's just going to be a bumpy ride. So hope everyone has a fantastic day out there, and I'll be back tomorrow. Well, the markets are closed tomorrow, but I will be back with the weekly wrap up. Markets are closed for Good Friday for all you good Catholics out there. I'm not sure what you do on Good Friday, but anyways, enjoy your holiday weekend, and I'll be back. Like I said, I'll be back tomorrow, and then again on Monday. So everyone have a good night. I'll see you then. Bye.